This changes everything. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, a new threat emerges against the global economy, and I want you to see why nobody saw this coming. Not one person, yet it's going to affect not just the U.S. economy, not just the Chinese economy, or even the Eurozone economy, but all major economies around the world. Plus, we have some new data out of Japan that now says the second largest economy in this world is far worse shape than we thought. And we're seeing that U.S. home prices continue to rise, but will that continue? We're going to show you what needs to happen for home prices to come crashing down. And we've got a bright spot in the U.S. economy, but will it last? We're going to make the case of why it won't. And if you're wondering what we're doing at the Federal Reserve today, well, it should be obvious. Fed Chair Powell spoke yesterday, and in overnight markets and in today's trading, stocks are down, interest rates are up. The question is, who will have the last laugh? And with that, let's head over to the Seattle Times, where we picked today's story up. Courtesy of the Associated Press, Japan records a trade deficit in August as exports to China and the rest of the Asian area weaken. Now, this is really important because when we think about exports to another country, or in this case, imports into China, imports are absolutely critical. In a global economy, which we are in, when you see an expansion of imports, that means demand inside of a country is getting stronger, and that leads to more prosperity and more economic growth. So when we start to see data or a continuation of a data series that say imports are declining, well, it tells us things in China are not in that great of a shape. Imports sank nearly 18%, the Japanese Finance Ministry said in preliminary data released on Wednesday. This left a trade deficit of 930.5 billion yen in August for the second straight month of red ink. So there's a trend starting to begin here. Meanwhile, exports to Asian markets fell 8.8%, while imports dropped about 13%. A large share of that was an 11% drop in the value of shipments to China, whose economy has slowed in recent months as hope for rebound from disruptions of the COVID-19 pandemic fizzled. So here we heard all this talk about perhaps the Chinese economy is starting to turn around. We've seen some rebound around the global manufacturing sector, suggesting perhaps the mythical soft landing that the Fed's trying to achieve will actually happen. We've said, no way, not a chance. This is seasonal issues due to back to school and holiday seasons, which is kind of causing a bit of revival in the factory sector. And now we get conclusive evidence out of Japan saying imports to China continue to drop, telling us demand from Chinese consumers is nowhere near where it needs to be to engineer a soft landing. And here's a validation of that: where imports go, economies follow. And meanwhile, we continue to hear out of the current administration and our policymakers that yes, indeed, that we are going to see a soft landing and that the U.S. economy is strong and robust. But yet, when you look at imports of goods and services, this shown in blue, coming into the U.S. against real gross domestic product, both shown on a year-over-year rate of change, what you continue to hear out of these political elites is the U.S. economy is going to grow and continue to extend its rally here. Meanwhile, imports are crashing. Now, you can look in the past and see they weren't quite synchronized, but nowadays in our modern global economy, where imports go, everything else follows. They're headed down, and they're going to continue to head down, suggesting that GDP growth is on its way to the downside in a big way. And we think the weak recovery in China will continue to have a negative impact on exports for a while, as it would make perfect sense that it does. But semiconductors seem like they're bottoming out from the down cycle. Well, any hope of anything to suggest that this downward cycle is over would be massively helpful. But one thing that's working against it, and we saw this today, interest rates jumped on Fed Chair Powell's talk from yesterday, his hawkish tone, which we'll cover more detail later in the show. And what do we see is this is the wrong move that the bond market is making here, because if we want to see internal demand from consumers, not just out of the US or China or Eurozone, but around the world, we need lower interest rates, not higher. And so what's interesting is we see a reaction out of the market today that interest rates must go up because the Fed's going to threaten to raise them some more. And yet, historically speaking, This is the wrong move. They follow imports to the downside. And when you see this together, it says that without lower rates, imports are going to further contract. And that's bad news, not just for the U.S. economy, but for the world. And here you can see, continue the theme from the earlier slide, we have imports of goods and services still in blue, now against the market yield of U.S. Treasury securities. This is the 10-year, and I want you to note that as imports head down, you see rates go down, and it makes perfect sense. This is just how the global monetary system functions. When demand falls, you have to spur it, and you do that by driving rates usually to new lows to get consumers and businesses to buy. And you see that trend over and over again, except now it's one of those few times, and we can go back here to the 1980s and see where imports were falling, the market drove rates up, and look what happened. They came crashing down. There was a bit of a rebound in imports, and then yields came falling just rapidly. We're setting up the same scenario here where investors think rates have to go higher, but the global economy says they're going to go down, and a lot further than most realize. And now let's take a look at U.S. existing home sales, because due to interest rates, at least that's the prevailing view, they're now falling to the 7-month low, that too on supply. But look at this, low inventory helped drive up median selling price to $407,100. So here you can see the case where the issue is home prices continue to rise and sales are going down, but many believe that home prices will not ever come down. And what did we talk about in yesterday's show? As we saw this kind of resurgence in refinances, and the experts were confused. Why are people refinancing their homes at higher rates? And we said, and we made the case, they can't get money anywhere else, but they have equity in their home. The question may be, for how much longer? Borrowing costs are now hovering around the highest levels in decades, discouraging existing homeowners, which is correct. Many who previously locked in lower mortgage rates from moving. And you hear more and more of this from people who are retiring and say, well, I'd really like to move, but I now want to give up my 2.5% or whatever their low rate mortgage is to go to a much higher interest rate. They don't want to do that, and that's keeping them there, causing part of the problem. The combination of high financing costs, diminished inventory, and elevated prices has created one of the least affordable housing markets on record, which is a shame for many younger people who would love to buy a home. Meanwhile, the median selling price rose 3.9% from a year earlier, as we said, to $407,100, one of the highest readings on record, creating a lot of home equity for people to tap. And yet here we see supply needs to essentially double to moderate home price gains. Mortgage rate changes will have a big impact over the short run, while job gains will have a steady positive impact on the long run. But you'll notice no belief that demand can come down here. So what will it take to see demand go down enough to bring home prices lower? Well, that we leave up to the banks. And here you can see all transactions home prices for the United States. This is in blue on a year-on-year rate of change against the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. Now, why we're using commercial industrial loans as well, they don't have as much data on real estate loans, but this is an excellent proxy for that because they're very similar in their data series. And so what we can see is home prices tend to go down, or their growth tends to slow when the banks are tightening standards and reducing the amount of people that can buy. We see that here in the dot-com bubble. We see that in the global financial crisis where home prices outright contract. And now we're setting up this case where, because of supply constraints, people say, well, home prices can't come down. The issue here, as we can see on the chart, is if the banks continue or even just keep in lending standards tight, then eventually demand will evaporate, disappear, and prices come down. That's a case that we're making, which will be validated when we get later in today's show to find out what this new threat coming from the Federal Reserve on the global economy is. And here's the bright spot, if we have one, is U.S. jobless claims now fall to 201,000, the lowest level since January, which is fantastic. This is great news for the U.S. labor market, but something else that should be rising and not falling, well, that should be your trading account. Let's give an update on crude oil here. This was a trade that we noted on our CTA-Timer Pro report. This trades with the machines. It gives you the machine positioning, runs a historical overlay. It caught this crude oil move way back down here. We pointed out where it told you to sell. This Then it told you to come back in up here and buy. It's done a mild pullback, and we think this crude oil is going up to 94. Experts say over maybe 100 of barrels we saw in previous shows. Right now, you'd be booking an 8% positive return on that trade. Let's look back here to, of course, August 31st, we see the machine positioning after settling on that pullback, go into a buying mode. That's always your signal on a pullback, is when it turns to buying to jump back in. Here it is, 100% long as of September 4th. And what have we made the cases? Where machines go, everyone else follows. The news picks up because they move the market. We've seen this from the Chevron CEO. We've seen this from other experts, all calling for $100 plus oil barrel per oil, and that, if you were on that trade, could be a double-digit return. Check it out. Link in the description below. A mere $30 a month, 14-day money-back guarantee. Meanwhile, initial jobless claims dropped by 20,000 to 201,000 in the week ending September 16th, within striking distance of the lowest level in more than 5 decades. So again, this shows us, that validates some evidence that the Fed says the labor market's hot. Well, maybe there's a reason why. Even continuing claims, which are a proxy for the number of people receiving unemployment benefits, declined to a mere 1.66 million in the weeks through September 9th. So what we can see here is that employers now aren't laying off hardly as many, and maybe they're bringing some on, but we do know going into the holiday season, and we heard this from Amazon recently, that hey, they're going to hire some people on. They need extra work, so it would make sense to see some of these people come off of the continuing claims, but maybe pick up lower wage or part-time jobs when they really need a full-time job. But nevertheless, the government doesn't care about that. The analysis is straightforward. While the pace of new hiring has moderated significantly in recent months, and if we've made the case will continue to slow, layoffs are still rock bottom levels. And while single weeks claims data is rarely a move in the big picture needle, these figures are certainly indicative of a still tight labor market. Of course, we note that employers really don't want to lay off right now. They just want to hold on to people. They're buying in to the broad view that we are going to hit a soft landing. I mean, they hear the Fed, they hear Jay Powell come out and say, hey, look, I think we got this. And all you have to do is hang on to your employees, give them a bit of a raise, and you're going to see the payoff. This is the case why this is not going to happen. And at some point, we're going to see mass layoffs. Going back to our import chart, here we have goods and services. That's shown on a year-over-year rate of change in contraction, as we noted below that horizontal black line. And what do we see against the 4-week moving average of initial claims? So when imports go down, what tends to happen is layoffs go up, because that tells us demand is falling, the economy is slowing, and we see that repeated over and over again. Here you see the dot-com bubble. Of course, imports came down, layoffs going right up with it. Global financial crisis almost right in sync, and here we see it now, but there's a bit of denial as we go into the holiday season. And this is why what we covered on the show the other day about demand, and why I asked you, are you going to spend more or less? Many of you said, hey Steve, you're talking, I have no money to spend more, I gotta have to spend less. And we've been making the case this is likely to happen. Employers are gearing up. They're going to be highly disappointed when consumers don't come out and spend, and that's going to turn around. We're going to see layoffs increase. It's just a function of how the global monetary system works. You cannot get a long-term contraction in demand without an equal response in the labor market. But one place that remains clueless about how the entire global monetary system works, well, it's none other than the Federal Reserve and the head, the chief, Jay Powell. As the Fed signals higher for longer rates, with hikes almost finished, stressing a careful approach. After a series of rapid rate hikes over the past 18 months that would make any central banker blush, the Fed can now proceed carefully, Powell said, a sentiment he repeated at least a dozen times Wednesday during a press conference that followed the central bank's decision to leave rates unchanged. And so what he's suggesting here is that we've reached kind of what they call terminal rate, or what they think the rates need to be to really bring inflation down. But what we learned from the Fed is, well, they don't actually know what that number is, because if they did, they wouldn't have waited 18 months to get there. They would have just moved it there out of the beginning and saying, look, we already know, here's our math, here's our data, this is where it's got to be. So what he's trying to tell us now is we're in a range, what he believes is a range where policy is near that terminal rate, suggesting that we may need to go a little bit higher, but he's not entirely certain. That's why he said, quote, proceed carefully, because he actually believes, or if not, he's suggesting that if he goes a little too far, well, well, that means the economy comes crumbling down. Little does he know that's already in the works. In the quarterly economic projections released following the two-day policy meeting, 12 of the 19 Fed officials said they expect to raise rates, even though they have no clue that they're not going to. But perhaps, maybe one more time this year, we'll see. The bigger takeaway for investors was a revelation that policymakers see fewer rate cuts than previously anticipated in 2024, in part due to a stronger labor market, which is hilarious because all we hear of these central bankers is they're data dependent. Now, do we have data from 2024 yet? Well, of course not. It's not possible. They can't even predict what they're going to do next month. So if you get the picture here, is for them to say that we don't know that we're going to keep rates at this level, go higher or lower next year. It doesn't matter, because if we ask them, and we do, we see interviews all the time. What are you going to do coming up? And Jay Powell and all of his cohorts say, well, we're just going to look at the data. Well, if we don't know what the data is going to be in a year from now, there's no way to predict, because we don't even know what the data is going to be by the next FOMC meeting. All that to say is whatever predictions they have, they're about meaningless. And yet what we can tell you is the bond market is screaming and continues to scream at the Fed that rates are indeed coming down, even though the Fed says they need to possibly go higher and stay elevated. Here we can see the 10-year, 2-year yield curve. This is where we take the 10-year, subtract the 2-year, and when it's inverted or below that horizontal black line, what the bond market is telling the Federal Reserve and the short-term interest rate market is, you are wrong. And when they're wrong, what we get into the understanding now of how money works in our economy and how the system works is you start to constrain the creation of new credit and new money, as you're about to see, and that leads to not higher rates, but significantly lower rates. And this is why every time the yield curve inverts, the Fed gets it wrong and is eventually cutting. Why we're saying that they can make all the predictions they want, but the bond market says you're wrong. The projections also showed they expect inflation to fall 3% next year and return to their 2% target not a whopping 2 years after that, suggesting that, of course, they have some crystal ball that tells them where it's going, and yet they still can't figure it out. In other words, the soft landing for the U.S. economy that looked more remote 3 months ago now seems within reach. It's almost as Powell's gotten some calls out of the White House and perhaps even Congress telling him to pull back on that recession call. They're basically saying that a soft landing scenario is going to be met with tighter policy. Well, that was the main takeaway. And the reality is you don't get a soft landing. They are mythical. The reason I keep saying that is because they don't actually happen. And so the idea here is that Powell somehow has a magic recipe that no other central banker in the history of time or future perhaps will happen. And he's going to engineer literally the impossible. I'm going to show you why there's absolutely no way he can do it. Because here we can see, again, looking at the consumer price index, that they say is not going to get down to their target, well, until sometime in 2026, if you can believe that. But meanwhile, the yield curve, or the thing that understands money in our economy, at least the one thing, says, fat chance, Fed. There's no way this is going to happen. We can go back and look at prior inversions, see how inflation continues to come tumbling down. And seemingly every time after we see a curve inversion, inflation or demand falls over and over again. This time, the Fed says inflation is going to surge higher, then come down, get stuck there, and then eventually get down to its target. Of course, the money curves are saying, no way, not going to happen. Inflation may pop here for a couple of months, but ultimately it's coming back down. And the U.S. economy has so far been resilient against the Fed's historic tightening campaign, which lifted the target range for the funds rate from nearly 0 in March of 22 to 5.25% to 5.5% here in July, a 22-year high. Consumer spending remains strong, although I'm not sure, because we've looked at these charts and suggest that it doesn't, and that going into the holiday season is going to get worse. But yet the labor market has been steady, as we made the case, probably not for so much longer. That strength bodes well for the Fed's efforts to cool inflation without sending the economy into a recession, but it's also raised concerns of the central bank that inflation fight could be prolonged. So again, they're stemming all of this hope on the labor market. And of course, we've noted in the past, it's not going to last. There's no chance as imports continue to fall and demand goes away, layoffs will go up, and the Fed will cut. Here you can see the 10-year Treasury minus the 2-year or the yield curve now coming to the focus on how money works in our economy. We look at the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes, and we note that any time where the blue line or the net percentage of banks tightening standards is above that, well, that tells us that banks are on net tightening standards, and anytime the yield curve is below it, it tells us that the curve is inverted and that the Fed is indeed wrong. And what we can now understand is the Fed claims that they're going to not just keep rates elevated, they're going to keep them up for a time, trying to force further inversion of the yield curve or just keep it inverted, meaning banks will have to continue to tighten lending standards, and that all that means is less money created in the economy. And when you start to understand that when there's less money in the economy, you start to get delinquencies, you get into defaults, things start to break, and ultimately, along with demand that goes down, rates have to fall in a huge way. Because if you think about it, what is it going to take to get people to go out and spend, to refi these things that are upside down, or to be solvent on their balance sheet? It's not higher rates, it's lower rates. But yet the Fed seems to be completely ignorant to how money works, because we can see their new projections reflected that, as Fed officials now expect their benchmark rate to be at 5.1% by the end of the next year, which is only a fantasy propagated by the Fed. According to the median estimate, which is up from 4.6 in the last projection, and that got, of course, Wall Street and the bond market all up in a tizzy today. And that caused treasuries to sell off, with yields on the 2-year, 5-year, 10-year, and 30-year all rising. And Wednesday's 0.9% from the S&P 500 was the second worst this year, only second to the 1.7% decline in March. And if you're really looking for the worst piece of news, it's not necessarily that we're going higher, but we're staying there for longer. And that's the new narrative. It's not how high, but for how long. The new narrative should be is it's not how high, but how wrong the Fed is. Because here we can see interest rate market knows more than the Fed, and sure enough, when banks on net tighten standards, their yields usually come crumbling down. And what do we see here for the first time in history, at least based on the data we have, that banks are tightening standards, the market thinks rates are going higher, and lo and behold, all it means is the reality is the bond interest rates are likely to make new all-time lows at some point in the future, and bond prices new highs. And yet the Fed chief has no clue how money works, because he cautioned that a soft landing scenario was not yet guaranteed, trying to already get himself out of a situation that he's creating, saying it was not the Fed's expectation. Of course not, despite what the latest projections implied. Ultimately, this may be decided by factors that are outside our control, already again adding to his narrative that he has to have an excuse, because a soft landing is what we've been trying to achieve for all this time. But in reality, when you start to understand how this works, this new threat against our global economy is the Fed inverting these yield curves and keeping them inverted and not understanding money. When they do that, you constrict the creation of credit, demand goes away, and next thing you know, everything's going to blow up and rates will be back at zero. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.